morning, everyone. We are delighted to have you join us today for today's session on enterprise de-risking, compliance automation, and risk assessment. The Excellencia Series continues to bring thought leaders together to share the practical insight on governance, risk, compliance, and emerging enterprise challenges. And today's discussion is no exception. It's my pleasure to introduce our keynote speaker, Mr. Nikhilesh Kochar. He brings a rich experience in the strategic insights in the area of enterprise risk and compliance. We are grateful to have him set the context for today's conversation. I would like to introduce him. Yeah. Nikhil sir is a senior governance and a risk professional with over 35 years of experience in corporate governance, risk management, and in internal audit. He's a senior partner at JHS and Associates. He was formerly the managing partner of Encocher and Company, which merged with JHS Associates in 2018. He has served as a boards in India and the USA, chairing audit, risk, and shareholder grievances committees of listed companies. He previously served as a chief advisor to IIA India and held leadership roles including COO, chair, advocacy, and president at IIA Delhi. A respected advisor and a trainer, Nikhilji works closely with ICAI, IIA, and the corporate clients and is known for integrating the governance and the risk frameworks with a business strategy to build resilient, high-performing organization. With this note, I would like to hand over the mic to Nikhil sir to take the session forward. Thank you.
Thank you so much, Deepika. Can you hear me clearly?
Yes, we can hear it.
Okay, great. Thank you so much. I think it's wonderful to have JHS continue with its Excellencia series, and especially when we are talking about de-risking, compliance, automation, and risk assessment. I will spend about 10 minutes talking about a little bit about risk management, which is an area of passion as well as study as far as I'm concerned. Fortunately, I've had a chance to work with quite a few organizations as far as risk management is concerned, from both sides of the table, as an independent director, as a non-independent director, as well as a consultant to companies. I think one thing which has changed over the last couple of decades, I think risk management started being discussed more in corporate environments, maybe from 1990 onwards. So it's almost, I would say, 20, 30 years old, or maybe closer to 2000, maybe 20, 25 years old. And I think what you would have felt would have changed is the pace and the volatility as far as risk is concerned. If you just look back maybe over the last 1 year or so, the world has been subject to geopolitical tensions. Statements from global leaders can make a difference to our stock markets, to our export and our import markets. There is trouble, political trouble, other kinds of trouble in neighboring countries, in several countries across the world. There are cyber threats which are happening. Regulatory complexity is getting more and more difficult to comply with. And at the same time, the environment is facing problems. You have stakeholder scrutiny, which is happening. And maybe just to give you a small idea of the kind of risks which we are facing, maybe some of the top 5, 7 risks which we face today would include, geopolitical tension. We could be looking at cybersecurity. We could be looking at regulatory complexity. You could be looking at business continuity. You could be looking at misinformation and deep fakes, which are becoming a part of our daily lives. We are looking at the environment, climate risks. So there are a huge range of risks. And fortunately or unfortunately, some of these risks are interconnected. A cyber risk in some company or a data leak in another company can actually trigger reputational damage. And as we are all appreciative that reputation can perhaps be the most valuable asset which a company can possess, and it takes absolutely no time to lose that reputation, and can take years to rebuild. So today, I think most stakeholders, especially boards and regulators, do expect that risk management becomes something which is a lot more proactive. It's no longer a siloed issue. Risk is systematic, interconnected, reputational. And as enterprise leaders, I'm sure many of you are there amongst our audience, we must look at moving from compliance as a burden to compliance as a strategic enabler of resilience. And I'm sure the speakers following me will have a lot more to say on that. I think we've all seen situations where in the past, traditional risk management used to just focus on tick marks, isolated audits. Uh, we have seen and we have humorously joked about certain corporates which for 5 years in their annual reports would keep talking about the same 5 or 10 risks, as if risks are never changing. But of course, all of us do know that in today's volatile environment, change is the only constant. And the risk meter and the volatility of risks almost looks like maybe a heartbeat count on a cardiac machine. So today, I think enterprise-wide risk management should be looking at integrating strategy, risk across operations, compliance, technology, and strategy, of course, so that you can have the benefit of a holistic view of the risks, better alignment between stakeholder expectations, starting from the boards, going on to investors, and have a little more better risk informed decision making. I don't think it's possible today to eliminate risks, but we can try to make sure that that our organization take the right risks at the right time and with the right controls. Certainly, technology and compliance automation can have a huge impact on this. What we have seen, both as internal auditors as well as people sitting on boards, are extremely conscious about the fact that compliance should be a zero risk game. So people do not want to fool around with compliance. Regulators are getting more and more proactive. Fines are becoming more and more punitive. So to the extent that we can use technology, we can use automated risk assessments, we can use continuous compliance monitoring across financial, operational, cyber domains. To that extent, we become that much better, faster at identification of emerging risks, making sure that risks do not have a bias and are more accurate, that those same risks could be scalable, specifically when you are looking at multi-unit and organizations, multi-locational organizations, which are working across different geographies, both within our country or sometimes across continents, as well as a certain amount of transparency as far as dashboards are concerned for both the boards as well as the regulators to be comfortable uh, with how compliance is being handled by the organizations we are involved with. It's not just about efficiency. Can we create a living risk ecosystem where controls are adapting as fast as risks are evolving? It's not easy, but it can be done, or at least we can try to get there. We do have multiple frameworks as far as risk is concerned. I'm sure most people involved with corporates are, familiar with the COSO ERM. COSO stands for the Committee of Sponsoring uh, Organizations. Then, of course, you also have the ISO 31000, which can be applied, across industries with, principles and processes for better risk management, whereas COSO tends to focus a little more on transparency, on governance, and strategy of the organizations who are actually adopting it. You also have, from the cyber viewpoint, you have the NIST, which is the National Institute for what does it stand for? I think Standards and Technology. It's a US-based organization, but the focus is more on technology itself. And then, of course, for the banking industry, you have Basel III, which comes across with a huge amount of guidelines talking about credit risk, operational risk, liquidity risks, and the kind of risks which are more impactful as far as the banking industry is concerned. So I think what we have to actually look at is the fact that, if we have risk management and compliance, automation becomes a part of it, or to the extent possible, technology is used for automation of risks. It's actually a strategic de-risking. By having software which immediately pops up and gives you reminders regarding compliance deadlines. There was a person who was sharing with me, a lawyer, maybe about 2 years ago, that a factory or a manufacturing based organization could have as many as up to 2,000 regulations which pertain to it. I do hope with the coming in of the four labor codes, some of those have come down, but obviously the number is still very large and very complicated. Keeping this factor in mind, I think if you are good at risk management, if you are good at compliance management, it actually gives you a strategic and a competitive advantage as far as your working is concerned. We as risk leaders, as internal auditors, as auditors, must play a very pivotal role in making sure that this culture of risk is embedded throughout the organization. Very often you find that risk is a term which people are familiar with in the top management and definitely at the board level. But as auditors, I think we have to use our noses and play a role as the ears and eyes of management, of the board, and give them the feedback regarding how much of that risk culture is actually prevalent and embedded at the lowest levels, in the middle management, and at the lower levels within the organization. So I would say that, future of enterprise resilience and organizational resilience lies in combining governance discipline with technological agility. If we can go in for better compliance, automation, and risk assessment, these are not just safeguards, but they are the foundation for sustainable growth as far as organizations are concerned. So with those kind of opening remarks, I'll hand the baton back to Deepika and ask her to invite the next speaker. Thank you so much for providing us this opportunity, and I do hope that the audience would learn from it. I'm looking forward to listening to the speakers also. Thank you. Deepika, you're on mute. I think you'll have to unmute yourself.
Am I audible now?
Yes, we can hear you. Thank you.
Okay. Thank you. Thank you, Nikhil sir, for those insightful opening remarks and for setting the strong foundation for today's session. Building on that context, our next speaker is Mr. Jatin Thakkar, who will take us through the risk assessment provisions, highlighting the key regulatory consideration and the practical approaches organizations adopt to strengthen their risk management frameworks. Jatin Thakkar is a senior compliance professional and currently serving as a executive vice president compliance at Kotak Mahindra Bank. In his role, he is responsible for strengthening the regulatory compliance, governance framework, and control system across the bank's operations, ensuring alignment with RBI and other regulatory requirements. With deep expertise in banking regulation, risk management, and internal control, Jatin plays a critical role in supporting business growth while maintaining a strong compliance and ethical standards. He works closely with senior leadership and business teams to embed a culture of compliance, transparency, and accountability across the organization. Recognized for his practical and business oriented approach to compliance, Jatin brings valuable insight into managing regulatory expectations in a complex and evolving financial services environment. His work focuses on integrating compliance with business strategy to enable sustainable, well-governed, and resilient banking operations. May I now invite Jatin to take the stage? Over to you, Jatin. Thank you.
Thank you, Deepika. Thank you. Can I check if I'm audible?
Yes, we can hear you.
Excellent. It's great to be on this panel with such eminent faculty. And I really appreciate Nikhil's opening remarks. This set the context in terms of what I'm about to get into, albeit I'll get into a very small component. Mr. Nikhil's experience is obviously much wider. So I'll just touch upon a few themes I took away as far as my notes is concerned from what Mr. Kochar spoke about. He spoke about uh, board stewardship, right? He spoke about corporate governance. He spoke about the various risks which entity faces, right, in terms of geopolitical, cyber, regulatory environment, and especially if we look at cyber, even the deep fakes and the like. He spoke about the importance of making risk-informed decision making. So that is decision making at a management level, acknowledging the risks which are there in the organization, acknowledging the risks which are emanating from external sources, and taking decisions accordingly. The key aspect there is knowledge, right? And that's where, especially in the context of banking, that's very relevant and very topical because of the constant regulatory changes happening. Literally, we see circulars being issued every week. And for those who are close to the banking, there was a huge consolidation exercise which was done a couple of months back, where over uh, a few hundred circulars were consolidated into master directions. Mr. Kochar also spoke about fines, right? So, as a case in point, I remember when I looked back in the year 2011, 2012, when the new derivative guidelines came, fines of rupees 10,000 used to be levied as token penalties, and maybe 5 banks used to get penalized in a year. As per the last statistics, the fines levied by the Reserve Bank of India, they have levied across banks, NBFCs, and the like, 353 cases or specific instances of fines being levied, and total penalty amount being 54 crore. Right? Those are staggering statistics. You don't want your bank to come up in that list on a press release on a certain Friday evening saying that the so and so bank has been levied so and so fine for so and so reason. So the reason I'm stitching all of this together is to really take forward from where Mr. Kochar left off, in the sense that it's very important for management to get visibility of what are the risks, where are my risks coming from, and that will enable informed decision making and enable or ensure that the organization has a proper risk recognition framework and thereby makes management decisions with complete knowledge and visibility of the risks involved. So, with that background, I'll sort of get into. I work for Kotak Mahindra Bank, so in terms of the specifics from a banking perspective, there is a specific mandate from the regulator, which is Reserve Bank of India, that we need to establish. There was a circular of Jan 2024 that there was a need for an enterprise-wide, integrated, workflow-based system. Now, all of these aspects are what Mr. Kochar already talked about, right? Enterprise-wide. So you don't need to see that in the context of a silo. It has to pertain to the entire organization. Integrated. This system needs to be integrated with the other systems already prevailing in your bank. It should get data inputs seamlessly without manual intervention or with minimal manual intervention, and workflow based. So what that means is that there are various stages of every process. So there has to be a handoff in terms of where each process is pending in the entire chain, including a strict audit trail. What often happens in banks is that even till late, we work on emails. So we get an RBI intent, we send an email out, we get a response, and that response is submitted. Obviously, that's prone to slippages, that's prone to manual errors, that's prone to the quality of the person who's giving the response, and thereby any response either not given or a response given with inadequate application of mind would place the bank at risk, right? And there are very serious risks. This harking back to the point which I mentioned on penalties. These sort of instances can have severe repercussions. So this was the broad framework given by RBI. Uh, Interestingly, when I look at what Mr. Kochar said, all of his points are actually emanating or being picked up by RBI in terms of their circular. There was another fairly interesting mention in the circular that it says you need an automated dashboard view to management, which typically, basis experience, they don't get so granular, but they did get granular. And the reason why they did that is they want to be more prescriptive, they want to be more directive, and they want management to get a view of the compliance risk across the organization. The other element of what was a surprise for us was that they also said that this system, which is to be built in banks, needs to be integrated with RBI reporting portals. So what that means is that there are various RBI reporting portals, the primary one being Daksh, where the banks get indents in terms of data requests from RBI, and the response also needs to be submitted in the system itself. RBI themselves do not are trying to get away from emails and stuff. So a lot of the migration of returns, reports, etc., has gone to various systems, and one of the systems is Daksh. So what they have mandated is that the system which you build for compliance automation needs to have the capacity to directly integrate with Daksh so that any mandate which RBI gives automatically flows into a system. And with minimal manual intervention, you push it further and then validate the response as a gatekeeper, and the response goes back. So the point, and why I'm stressing on all of this, is that what we see is a regulator who's getting more and more tech aware, tech savvy, and in a lot of cases, the regulators already 5 steps ahead because they have set various teams who just analyze the data and highlight the exceptions then and there. So even before the RBI inspection starts, they have a laundry list of cases where they say these are apparent exceptions basis data submitted by you. So please let us know why these are not reportable cases. So it's almost as if banks are playing a catch-up game with the regulator when it comes to data analysis and the like, which is very important for banks themselves to up the ante and sort of ensure that they themselves, not just compliance automation, but even from a wider system perspective, banks should uh, get into a system whereby these exceptions come from the system itself rather than someone going in manually and checking. In addition to RBI, there's also a self-regulatory body called Indian Banks Association. Indian Banks Association, on the back of the RBI circular, requires a few more modules to be built in line with the compliance automation initiative. Basically, they require that there need to be compliance testing and self-certification modules. So what that means is that when there is testing done by compliance team, or when the internal audit does a review, or where RBI issues an inspection report, any failures in that report need to be logged in the system, tracked through the system, and the scoring mechanism should also factor in the fact that a negative finding has been issued and what measures is management taking to address it. And the workflows which I just mentioned, they sort of need to be built at the back of this. Uh, Also, the regulatory returns. There are 112 regulatory returns which are published for banks to submit on the RBI website. In addition to those 112, there are various other ad hoc reports generated either periodically, defined periodicity, or even ad hoc, which need submission to the regulator. So this system should be capable of catering to a sort of a repository of regulatory reports, and also should enable the bank to escalate cases where the regulatory reports are not submitted on time. So what we now see is that there is a regulatory requirement from the RBI circular. There is an Indian Banks Association nudge with regard to the various other modules that need to be built around it. And it basically is a reality for banks to sort of go into and develop that model. So across the industry, and Kotak is not an exception, we have built a tool. It's based on a popular GRC platform, and that tool enables all of this to happen. So just talking in terms of numbers, to Nikhil's point earlier, uh, across the industry, we across for the bank, we have identified over 3,000 odd circulars, which translate into 6,000 obligations. So each circular has got requirements, and each of those requirements, so one circular could have five, one circular could have 500. So there are 6,000 obligations which have been identified. And what, from a starting point perspective, we've culled out the circulars, we've identified the obligations, and the next step is to figure out what are the controls we as a bank have to meet those regulatory obligations. So that's a huge mammoth exercise which we had embarked upon, and this is not just for RBI; it's even for the other regulators. So if I step back a bit, the earlier approach which Mr. Kocher referred to was a tick box approach. Uh, all of you, those of you who work in risk management or in compliance, will be familiar with the Excel sheet, the likelihood, impact, etc., residual risk. And it was more in terms of understanding what the risks are, documenting that in an Excel sheet, and basis what you know, assessing whether that's a risk area or not. Right? That's, I would say, that's a more top-down approach in that sense, where our starting point is where we need to be, and then we build out and go down and build out the framework. This approach is radically different, and the reason why it's different is that it's bottom up. From a compliance perspective, what we realize is that for a bank to be compliant from a regulatory perspective, you need to ensure compliance with regulations. That's a non-negotiable. So by coming from a regulation perspective, keeping the regulation as a starting point and then building up, that enables you to get a much more refined view of risk, coupled with the factors of failures observed in internal audit, failures observed in compliance testing, failures observed in one other element which I want to introduce now, is failures observed in key risk indicators. So these are automated key risk indicators which ping the system, realize if there's an exception. If there's an exception, it's a fail. If it's not an exception, it's a pass. So there are a whole host of literally hundreds of key risk indicators which run across various regulatory parameters and get inputs in terms of what, if any, are the failures. So all of this is ingested in a system, plus the regulatory reports, any exceptions arising from regulatory reports, and open indents. So all of this sort of enables, all of this data needs to be managed, right? And the tool enables us to manage it. So all of this data is sort of ingested in a sort of a model that we built, which gives out a risk score. So how that risk score translates into a bank-wide view and effectively a neck to catch is that from a top-down perspective, we've analyzed the various units of the bank. So various an obvious unit would be retail bank, commercial bank, wholesale bank, etc. So we've identified these units. Within each unit, there are what is called assessment units. So a consumer bank will have a credit card product. A consumer bank will have a gold loan product. So likewise, each unit has got assessment units, and the control mapping and the regulatory obligation mapping is done at each unit level, and then it rolls up into an overall bank score. So that's how the model has been constructed. That's how the scores have been developed, and we, at the click of a button on any given day, management can get in and identify which unit is higher risk than which other unit. So there's literally a ranking of units which is driven by a statistical base. Uh, in addition, where I talked about obligation versus control mapping, also the attributes of the control are also being captured. So, for instance, if the control is a preventive control or detective control, if it is manual control, or if it's based on the system, is it subject to concurrent audit? Yes or no? So, depending on the inputs for each of these points which are captured in the system, there is a risk scoring matrix behind it which assigns a risk score to that unit. So This is basically the nuts and bolts of how the system works. Obviously, like we had in the earlier Excel template approach, there is an inherent risk, there is a control risk, and there is a residual risk, and that's how the scores sort of build up and sort of get aggregated at a bank level. So at any given time, one can compare that 3 months back, such and such assessment unit was rated uh, at this number, which is indicative of high or medium or low risk. And now, because of improvements made, maybe they've introduced concurrent audit as a checkpoint, their risk score has gone down. Now, if you view it at a top management level, these are exactly the insights that they're looking for to make decisions with regard to our compliance or regulatory approach. Not that we take a view that we don't want to comply with regulations, but we know that if in tomorrow, if the Reserve Bank of India were to step on my door and asks, what as a bank do you know in terms of which are your high risk and low risk units from a regulatory perspective, we don't need to go hunting around. We just have that available at the click of a button. So I think those are the various very high level overview of how we build the model, what we are doing with it, what is the meat of the model, and the scoring and the various modules which are built around it. I can get into much more detail, but I just want to check with the moderator if we have more time. Uh, Deepika, all yours. I think you're on mute.
Yes, yes, you can continue
I
sometime.
can continue. Excellent. So what I'll do is I'll spend maybe 5 minutes talking about some of these modules, and also in terms of how we getting a bit granular in terms of the sort of the risk assessment, right? So when we talk about the scoring model itself, right? The parameters which we use for inherent risk. Inherent risk, there are sort of two lenses to look at it. One is the likelihood assessment, and one is the impact assessment. So from a likelihood perspective, for inherent risk, one of the factors we look at is increase in business volume. So let's say for a certain particular unit, for instance, gold loan, if you're doing business of 2,000 crores last year and is doing a business of 5,000 crores this year, right? The inherent risk of that unit has gone up. Now, what we need to do about it, that's a separate matter. But purely from a risk scoring perspective, just basis the increase in business volume, that risk has gone up. We look at regulatory, mind you, this is a compliance model. So we look at the regulatory obligation complexity. So for instance, if a business unit has got maybe 20 obligations, it's less of a risk than a business unit which has got 100 obligations. Very loose example would be, let's say, gold loan unit. While the obligations are fairly intense and prescriptive, if I look at, on the other hand, I look at credit cards, right? It's a bigger piece of regulation with maybe more regulations and obligations to meet. Therefore, the inherent risk, or from a likelihood perspective, for credit cards business would be a bit more than the gold loan business. From an internal perspective, we look at system complexity, right? So just to run that business, a very crude example is how many systems are you sort of leveraging. To Mr. Nikhil's point, more and more complexity you introduce, the more and more your risks go up, right? So if as a business unit I'm relying only on two systems, one the customer record system, and other system to just manage my book or manage my credit assessment. So a unit with exposure to two systems is much less riskier than a unit with exposure to 20 systems. Like if I bring the customer lens, then also there will be systems with regard to outreach to customers. I run my call centers. I have to generate MI collections. I work with multiple collection agencies. So wherever there's more systems being introduced, the inherent risk of that business goes up. I look at obligations which are pending implementation. So any RBI circular requires time for implementation, depending on how complex it is. Some might require more time, some might require less time. So any unit which has a pendency which is a bit higher would get a risk score which is higher. Customer complaints. So for customer facing units, the volume of customer complaints as a percentage of their customer base is a critical input into my likelihood assessment from an inherent risk perspective. Uh, for inherent risk, the other lens which I capture is the impact assessment, right? So impact is a it's a bit difficult to capture because you can't really. It's sort of getting into a derivative of a derivative. So I am looking at if something were to go wrong, what will be the impact? So something were to go wrong is an unknown. What will the impact is another unknown. But yet we sort of apply some sort of lens to that to ensure that we are capturing it. So the impact which typically we look at is if something were to go wrong, knowing our knowledge of how RBI reacts, how penalties are levied, which areas are subject to penalty more than the others, what will be the impact on media coverage? So if there's an adverse news in the media, what will be the impact, etc. We apply some sort of logic in terms of how to measure impact. So these are factors which go into inherent risk assessment. Then when you look at the control risk assessment, there are two attributes. One is the quality of the control and the other is the performance of the control. When I say quality of the control, if I were to use our familiar jargon, it's more on the design of the control. When I say performance, it talks about effectiveness. So when I assess quality of the control, I look at the level of automation achieved. So if a unit is all the processes are automated, there is very minimal minimal manual intervention involved. Customer onboarding is basically seamless, either video KYC or basis an Aadhaar e-authentication. It would score a less risk profile than a unit which still relies on paper documents and the like. And I mentioned earlier in terms of preventive or detective control. So if it's a preventive control, that would be a better attribute to have than a detective control, which is you realize that there's been a control issue after the control has lapsed. I look at the level of documentation, right? So this gets quite granular in terms of if I have certain X obligation against which I've got a Y control, is there documentation to prove that that control exists? Do we have that documented in the form of SOPs, right? Are those SOPs subject to review? Because the entire universe of the banking industry, there is a central record of SOPs which are questioned by the operations risk unit in terms of have you reviewed it? Are there any changes or not? So that ensures a seamless governance process around the entire SOP and the process design aspects which get addressed through ensuring this. So which is why when we are assessing control, we look at whether the documentation exists or not. If there's no documentation, you get a poorer score. And also I mentioned in terms of coverage, in terms of concurrent audit, reconciliations, any control checkpoints, etc., which sort of add into the control attribute and thereby improve the quality index and reduce the score. Then we look at control performance, right? The other lens of control environment, where we look at for every unit, we look at what is that unit, what would an exception look like? And if an exception has got certain attributes which you can pull out from the system, we build those pipes from the data warehouse into the unit such that any exception which is run on a periodic basis, it could be monthly, it could be quarterly, it could be half yearly, that exception gets auto-populated and thereby the score goes up. This is one of the toughest pieces to achieve because not all data points are amenable to binary exception decisioning. Some of the data points require more investigation. There might be a reason why the data point exists this way, or it could just be a failure in control, which needs to be addressed. Then there's also an attribute where we ask the business team to do an assessment from a first line from their perspective and give a certification. And the thing which I mentioned earlier in terms of compliance testing. So all of these sort of form part of looking at the inherent risk, looking at the control environment risk in terms of quality and performance, and give us an inherent risk score and thereby a control and residual risk score. Deepika,
Thank
time
you.
check.
Yeah. Yes, we are on time. Thank you, Jatin, for the insightful session on the risk assessment with reference to the 2024 circular. And now we move to the next segment of today's webinar. Mr. Gaurav Jain, I would like to invite Mr. Gaurav Jain. He will be speaking about the compliance automation, focusing on the how technology can enable organization to streamline the compliances, improve accuracy, and reduce overall enterprise risk. Gaurav Jain is a founder of Lex Comply, a tech-powered compliance management platform that helps business keep their legal compliances in green. Lex Comply was founded in 2015 with the objective of automating the modernizing how organizations manage regulatory obligations through technology-driven solutions. A qualified company secretary and a law graduate, Gaurav brings over 20 years of experience in corporate law, compliance, due diligence, and a startup legal operations. His deep understanding of regulatory framework and compliance business challenges enables him to design the compliance system that are both robust and user friendly. Through Lex Comply, Gaurav supports companies in building structured compliance frameworks, improving visibility over obligations, and strengthening governance and control environment. He is known for integrating legal expertise with technology and innovation to help the organization achieve sustainable, efficient, and well-governed compliance practices. Gaurav, the stage is yours. Over to you.
Thank you, Deepika. Good evening to all, and thanks to the leadership of JHS and the eminent speakers for this opportunity. Deepika, I hope I am audible. Yeah. So, first of all, I'm quite overwhelmed with the knowledge that has been shared by Mr. Kocher and Mr. Thakkar, and I think sometimes as a student, you feel that I think the course is entirely covered what to speak. All the answers given, but yes, there is always something which is left for the young members to contribute. And as a student, I would like to share my thoughts. So I'm still a student of compliance, and as my eminent members have been speaking, that so many modalities around risk, compliance, technology aspect, cultural aspects, have the complexities around it. So I'll take the discussion forward from wherein my mentors have left it. So when I look at it from the building the compliance and automation to de-risk the board, the KMPs and the officers, because today, compliance, yes, though it has been thought as a cost from years, but I think with the kind of the strategic activities happening, whether your M&As, JVs, IPOs, private equities, angel investments, acquisitions, the importance of compliance and the risk and controls increasing immensely. And that leads to an important question: how to ensure that we are compliant in letter and spirit, and also ensure that the team members who are contributing to the growth of the company are de-risked along with the company in this entire process. So how I understand or how we take it as Lex Complier, this entire thing is that there are two aspects of it. One is a cultural aspect of it, and other is a technology aspect of it, which is an enabler aspect of it. What we have experienced that while you may implement or plan to implement or you may take a lot of initiatives, but unless and until there's a kind of a culture being built in within an organization, respecting, having respect toward a process, towards the compliance, towards the risk, which an organization is exposed to, it is very, very difficult to make any good initiative giving you fruitful results. So what we normally suggest as an organization to our clients, that while you are planning for an automation to de-risk yourself, it is very, very important that first of all you understand what is that risk and who are the owners of those risks besides as an entity. Okay. So the first thing is that there is an has to be an independent assessment of what are the applicable laws and compliance, because that is the first step towards to being a compliant organization, because there has to be an evaluation, and then comes the risk associated with those compliances. And most of, because as you will see that most of the time directors directly in every law being held accountable, apart from an organization, to be subject to monetary imprisonment, and obviously their personal goodwill on the stake, and likewise the KMPs. But what we have experienced over the organizations, that they lack one of the key activities, which is also, by the way, provided in the Companies Act. Okay, there's a specific provision that anybody signing the document of the company should have authority from the board. This is a very, very important, very small compliance, but largely missed, and that adds to the risk of the directors as well. So while you have identified the compliance and execution of the compliance responsibility, it is also important that to educate that person, that particular department, be it regulatory, as Mr. Thakkar was talking about from the RBI regulation perspective. Now, if you look into within RBI regulation, it's not limited to only regulatory department. It covers any and every department, by the way. It covers your finance, it covers your treasury, it covers your sales and marketing, it covers your IT. The RBI laws are such structured, right? So one is they should be knowing about it, they should be trained about it. Then there should be an authority and accountability matrix, especially authority matrix in place, okay, wherein the powers should be delegated to execute and sign the document, respective documents under the authority, so that, and that it gives a power for a person to execute the document on behalf of the company. Secondly, simultaneously, it is creating an accountability, a responsibility on that individual, other than a director as well. And those authority matrix should be approved by the board. And such authority matrix, there is a provision to also inform to the, in some law, there is a provision to inform the regulatory body. Otherwise, within Companies Act, there is a residual form wherein you can upload this document for public domain. Okay, so that sets up 2-3 things. One, you know the compliance, you know the person who is accountable, you have given that authority, you have de-risked the director because now it is being signed by the respective HODs. Okay, and that says while you are going into litigation, you can always prove that authority and accountability has been rightly delegated. But besides that, the idea is not to make someone only accountable. There should be a mechanism of learning and development within an organizations to continuously educate them, brief them, and enable them in knowing and executing such compliances. I'm again referring to again what Mr. Thakkar said. It was, I think, 28th or 29th November when around 247 or 200 plus circulars came in a day with the immediate impact in RBI. Just 7 days before that was labor codes. Then you are having income tax act, income tax code coming in 1st of April. Environmental laws seeing a sea change. Then likewise, SEBI laws are changing under the process of consolidation. Now, most of the compliances are not changing, but how does that individual know about it? Okay, so there needs a training, learning, and development process. Okay, to enable them to know what are the incremental compliances, what the changes have happened or not. While you have all these things in place, so there has to be a compliance management plan. This is what we term as a compliance management plan. Okay, and what we educate is always have a dedicated compliance management committee with all the respective departmental heads. They should meet quarterly with a very, very focused approach of compliances and risk associated with the compliances. Understand the key challenges of each department, key stakeholders, and then the compliance management plan should be made and reviewed periodically, tested periodically, and necessary measures should be taken around it. And one of the takeaways can be obviously to automate the entire process. With Mr. Thakkar has very detailed explanation, because nothing better than him, nobody better than him. Reason is he's dealing with a regulator who is like always top of the head. Okay. Now with Daksh portal coming in, there is a lot of transparency have come up. They have the first regulator to mandate automation, by the way, because there is a provision Companies Act though that board have to certify that they have a system in place. but that's not technology system. It's just a word system. The system can be on Excel and system can be technology or non-technology driven. But this is the first regulator in India who has come up with an obligation like that. And obviously, the banking channels have a lot of complexities in the operations. So, thus, entire compliance management plan should be well structured to identify, enable, make a person responsible, test the effectiveness of the plan, various initiatives, review it, and then keep on implementing it, keep on meeting regularly. I tell you what we have experienced while we have implemented in some places these compliance committees. Interestingly, a lot of compliances depends upon your new business things starting, not because of the labor laws, not because of the environment, health and safety, but because of your innovative business activities. If we stick to like BFSI today, no bank is just a bank. They're doing everything in today's time. There are pure e-commerce companies as well, in a way, right? They're selling a lot of things online as well. So there is no such fixed activity, and all these activities result in some level of new compliance obligation which has to be taken care of. So that is the value which comes in when the leadership teams meet frequently. They get to know about a new development in the company, and that is the way they are able to build up their compliance landscape more effective and more efficient. Now, again, I'll not repeat much what the compliance automation can help you. Obviously, that while you have this entire process of allocating the roles and responsibilities, the maker checker functions of the reminders and escalation, real-time management dashboards will happen. You have a centralized repositories happening, and most important, the legal updates, which is very, very important in today's time, which is past 2 years, almost like listed companies and BFSI sector has been seeing almost like 300, 400 circulars in a year with the material changes happening. So these updates are very, very important, and then they has to be assigned to the right stakeholder with the right knowledge, learning, and development happening. And linking it that with your ERMs, as Mr. Thakkar was explaining, the right controls in place, then their parameters in place, and you have a centralized repository. And what is also gaining importance is thinking beyond India, right? Because we cannot ignore the global importance of our Indian companies who are either part of some foreign subsidiaries or are Indian MNCs having overseas operations. So then you also have to look into what is happening for your global operations, small or big. They have their own regulations to take care of. So again, all these things, while you have a robust culture, you have a process in place to understand what is improving, what is growing in your company. Then as a compliance officer, as a chief risk officer, you can plan to implement those compliances, those controls, those risk mitigation measures basis what are the activities happening across your organization. And thankfully, I think we are in an era wherein because of all these material changes happening, limited skill set, complexities of the business, there are elements of, I would say, if we keep on doing manually, there are always elements of some misses and some gaps. Uh, and wherein this management processes and automation plays a very, very critical role. Thankfully, with this emerging technologies, which has been on years earlier, it was bots, then RPTs, and scraping things coming up, wherein you can do a lot of automation around the processes and controls. And with this now AI and machine learning stuff, the things have radically changed. However, obviously, one has to be very careful from the data protection perspective. And again, for using those technologies, the right approach is very, very important, and the objective has to be very, very important. But what we have experienced or what seen and what we have tested within ourselves from the AI learning, AI part of it, it can play some very, very critical role and very important role, not only in keeping you updated with the changes that is happening and advising you into what extent it is very, very relevant to you, provided you a structured database. So people talk about AI's hallucination, but all those things, if you have a structured knowledge base in place and you have your specifics about your company, AI can really help you to give the right results, and those controls can be inbuilt within compliance oblique your ERMs to give you the right insights about it. So I just give you an example. So while on compliance tools, somebody has to upload a proof of compliance, say TDS or RBI return filed on this date, and send it to the maker checker, to the approver. And what normally happens, that approver is some senior manager person who hardly have a time, and he or she clicks approve and close it. Then HODs and management is saying, okay, green, green, green everywhere, right? So, but is it a right picture? Is it a correct and true and fair view of your compliance status? So, using some emerging technologies, you can ensure not only the right document is being attached without manual intervention, they can also check the correctness and relevance of that document pertaining to that compliance obligation before it is being sent to the approver, so that the human intervention, whether it is human error or it is an intentional error, both the things can be taken care of. Likewise, this process can also be adopted or is being tested to be adopted for reviewing, testing, and auditing purposes of the compliances reported on the systems like compliance systems, to ensure that the true and fairness is maintained. The user is made more accountable and literate to give them a right pop-up around it. Uh, that is one way. I would say, then when we talk about critical compliances, and where the lot of misses happen that in compliances. So while there are compliances pertaining to registrations, there are compliances pertaining to tax and returns, and there are certain ongoing obligations which are your procedural compliances, which are being taken care of through SOPs and controls in place. But there is one critical, very, very critical aspect of compliance, which is corporate action based compliance, okay, which depends on some financial and non-financial parameters. Like, for example, if I take the clue from what Mr. Thakkar said, that, for example, your asset base increased from 2000 to 5000 crores as an NBFC, right? Suddenly you are into maybe into a different category altogether, while your tool have a certain set of compliances, and during the financial year this is increasing, then how your compliance officer or your regulatory team will get to know about this change? Likewise, there can be thousands of such events which can be increase in number of employees, profit, turnover, capital, opening of branches, closing of branches, change in directors, change in CEO, COFO, CROs, CCOs, CEOs, CTOs, how all these things you are ensuring that the impact of these corporate actions are being taken care of without any human intervention. Like, there are controls in tools wherein they ask you about this corporate action, but again, it is dependent on human, wherein AI is again uh, can play a role, wherein it can be integrated with your right technology tools which you're already using, like your ERPs, your HRMS, your loan dispersal portal, wherein you can collect all that information in a particular way, and then the compliance knowledge sitting at a central level to tell you or prompt the CRO or the CCO that, hey, this is an corporate action that has happened, and this is the potential compliances linked with this corporate action. I think in banking, the RBI policy rules are inbuilt within their Finacle tools. Likewise, this activity can also be done around your entire compliance gamut, which I see that is what will be the future of de-risking through automation, because there are a lot of human elements and a lot of non-compliance is not happening because of non-filing of returns or registrations, but misses around, oh, this is an event which was I supposed to take care of as a compliance, okay, which maybe, I just give you an example, even if you're changing your website name or domain, that may lead to maybe 30, 40 registrations impact, because in every registration you give an email ID of the concerned person. If your email domain is changing, then you have to inform the department about that change. Such a small activity having a larger impact. Just imagine companies having branches or retail stores across India having 2000 licenses or 400 licenses, and how that team will be aware, okay, the domain have changed. You know, the brands keep on changing, right? Uh, and their email IDs accordingly change. So that has an impact on it. And wherein that integration of your daily activity with your compliance or risk management applications through a gamut of AI and knowledge is very, very important, and which I see playing a lot of role. So I'll just take a pause here. I can go into a lot of details and nitty-gritties around it, but I'll just, respecting the time, I'll just take a pause here. Thank you.
Thank you. Thank you, Gaurav. This was really very insightful. So we have received few questions from the audience, so I'll read it out and maybe any speaker wants to take it. So our first question is, what upcoming regulatory or risk trends should enterprises start preparing for now? So, am I audible?
Yes, sir. Jatin sir, you want to take it?
I
Nikhil
would
sir?
leave this to the expert on our panel. But my 2 cents on this would see, the regulator is always, one has to understand why does the regulator exist, right? The regulator exists to protect the customer and to ensure system stability. So anything which the organization does should replicate what the regulator's intent is. So if I'm making any decision, if I'm making any business strategy decision, if I'm making any uh, risk-based decision, if I place myself in the shoes of a regulator, what would the regulator think about it in terms of these objectives? So whether 10 years back, whether now, whether 20 years hence, no matter what, it's like the Bhagavad Gita, no matter which lens or which century you look at it, the underlying principles remain the same. So I would apply those principles to see where, in which direction is the bank going, or in which direction is any entity going for that matter, and then view it in the context of what are the indications I'm getting from the various speeches the governor makes, the various speeches the deputy governor makes, various speeches the executive director makes. They give a thought process or insight into what the regulator is thinking. One of the recent themes which came from regulatory speeches is on the theme of customer service, right? They expressly said that they're not happy with the QRC framework, right? So QRC means query request or service request, or query request or complaint, right? So banks take a view in terms of where to categorize that, and that led to suppression of complaints. So the regulator was not happy on this, which came as a forewarning. And if banks orient themselves to ensure that from a system perspective, they are falling into the right patterns of behavior expected from a regulator, then not just as a bank, but even as an industry at large, you're aligning with what the regulator wants. One other recent, I would say, flavor on the street is mule accounts, digital arrest. So you get a sense of what the regulator is thinking, where the industry is going, what are the concern areas, and it's not rocket science. At the end of the day, all you need to do is do a quick AI search. Maybe if you craft a query around what are the regulatory concerns expressed by in the various speeches, assertions, etc., you will get a beautiful one-page document, and I can talk about that on this forum for literally 10-15 minutes. But I'll take a pause there. I'll leave it to the expert.
Sir, would you
I'm
like to add
sorry, Deepika, would you like to just repeat the question, please? I think I missed the earlier part.
Yeah. Yeah. I'll I'll read it out. What upcoming regulatory or risk trend enterprises should start preparing for now?
Okay, well, I think Jatin has actually answered that question so well that there's no real need for me to add something. But just another context is that, if you're a student of risk management, as I'm sure all of us are, perhaps it does make sense to try to look out for emerging risks, because when you're looking at trends, there are some things which become more and more probable as time is happening. And, we started hearing, say, about deep fakes a couple of years ago. But then we started actually hearing stories about how CEOs or CFOs were actually giving out instructions on videos for monies to be transferred to various accounts, and all these videos were deep fake, and even the person who was authorized to remit the funds could not make out. So I think we have to basically just keep our eyes and ears open, look at what all is happening. You're reading so much about digital arrests these days. I think perhaps every citizen, senior citizen that we are in touch with needs to be warned about the fact that this is very much a likelihood today. Deep fakes are another. So I think similarly, there are so many new things which are coming up. That based on the industry which you're in, if you can start looking for patterns and trends of forthcoming or potentially forthcoming risks, perhaps you can actually stay one or two steps ahead of the regulator, because what is the purpose of the spirit of the regulator coming in? It's to just make sure that the customers are protected. And I think if you can preempt that from happening, I mean, I think your regulator should actually not be your concern. Your customer should be your main concern. Sorry, it's just a different perspective. Thank you.
Yes, yes. So aptly mentioned. We have received one more question. How should organizations measure the effectiveness of their compliance and risk management system? So,
I think Gaurav should be the best person to answer that.
So I'll just answer the first part of it, sir. I dare not take the risk part of it. But yes, I think the traits are very simple. I think effectiveness first is, I think the blood of the compliance system is the compliance obligations, whether they have been completely or comprehensively mapped to the right individuals or not. Right? That is the first part of it, because without that, it is just an application or maybe a body without a life. Okay. Second part of it, that easy to use, and whether it is testing or ensuring the correctness of the documents or information put in without much compromising on the data security part of the, because all the documents which you upload or information you upload is highly confidential, and today technology have a lot of things around it. But what we need to ensure that there are some technology testings also besides relying on just human, and because they can be, again, as I gave you an example, that maker, checker, HODs, the checker and HOD levels are one who are largely occupied very much about it, right? Uh, then what is, I think, simplicity, as I said, it should be ensure in a way that it should consume the least of the human time in reporting, because as Jatinji just said, he's right, 6,000 compliance obligations. And out of that, you may presume, please, that 2 or 3,000 coming to one user for sure. Correct me if I'm wrong, Jatinji, right? Now, if you're asking an individual every month to tick box or upload something around it, it meant sometimes we try to do overachieve. So you have to take a journey to achieve 100%. It will start with 20-30% only to make a roadmap, right? And then how that different categories are being triggered to a user, that is very important. And I think most important, legal updates, okay, how they are being shared. Secondly, how the interpretation or impact analysis of those legal updates are being done, and is it allocated to the right person or not? Okay, after due process being followed. If you have that entire thing, I think, and to make it effective, the leadership should have a focus on the performance of the application. That is very, very important. At the board level, uh, besides CEOs, it should always go to the board level so that the people feel serious about it, because sometimes what happens that the other leaders may try whatever luck they want to, but unless until you HODs know that okay, it is going to the board levels, CEO levels, then comes the seriousness of that thing about it. So risk side of it, sir, Jatin sir, Nikhil sir.
Jatin, please.
No, so I absolutely echo what Gaurav said, and that's the use case which he brought out is especially relevant, right? People don't know what they're signing, and they're signing for compliances of 200 odd regulations, which we practically, from a design perspective, we are supposed to be auditors and questioners, so we know that that is not physically possible. So maybe address that very briefly is that we don't have 200 regulations mapped to a certain business owner. The business owner gets the regulations which only are relevant to that business owner, and the self certification exercise every quarter is done
Yes.
only with regard to that cohort, right? So likewise, there are over 90 odd businesses which we've identified. When I say businesses, I mean the customer facing business units as well as support functions. So each of them are a separate compliance unit, and therefore the regulations which are mapped at that level sort of echo with that person's scope of work. But I think from a wider perspective, any risk management framework, any and alluding to what I touched upon when I spoke earlier, there was a top-down approach, there was an Excel file, now it's bottom-up, right? So
Yes.
it's sort of evolving into that space. Is we are not entirely there yet, but we need to get there, because for appropriate decision making, for appropriate uh, ensuring as a regulator, we protect customer interests, we protect system stability. It's important that banks put in the hard work and get there. And I must congratulate RBI for being ahead of the curve and thinking about this. As Gaurav was saying, there is no other regulator who's been so prescriptive. The regulator has actually said you need a
Yes.
system, it should be automated, and there should be dashboards. In my history of reading RBI circulars, you have, except you leave aside credit related circulars where you need to get specific, this is the first circular on compliance which has actually gone down to that level of granularity.
Yes.
And more importantly, it's not a compliance deliverable, it's an enterprise deliverable,
It's a,
right? So it's not something which only the compliance unit will steer, or yes, it will lead the initiative to ensure the entire framework is embedded, but the framework belongs to the bank. In one of the earlier speeches of the one of the governors, deputy governors, and this is a dated speech, it's almost 2 years back, there was a mention of harmonization of assurance functions within the bank from an automation perspective. So while the platform has been set for compliance automation, it is a regulatory nudge that other risk units also sort of contribute in this, and across the entity, you have got one golden source of truth. So to give you an example, while there is this compliance automation which takes care of regulations, obligations, controls, there also should be an overlay from a operational risk perspective in terms of policy maintenance. So as a bank, there are over 200 odd policies which are required from a regulatory perspective to have board approval or ECB approval or whatever the case may be. Now, you can't have a governance framework for managing these approvals running in an Excel file. That's very inefficient. So the expectation of the regulator is that you get that into this tool so that it talks to the other components. So I'll give you a case in point, right? And sorry, I'm getting a bit granular about it, but this is very important to understand. If I have a regulatory obligation saying that the bank should have X and XYZ policy, in the control I say, yes, I do have a policy. The last policy version was version 5, approved by the board on 1st of Jan 2024, right? That remains in the system, but therefore what? So by tying it into the policy module, that input which is given in the control description gets automatically updated once the policy gets revised. It's a good governance practice to retable all policies every whatever period the bank wants to choose, whether it's 2 years, 3 years, whatever, even if there is no change. So at least you can demonstrate to a regulator that someone has actually gone, opened the policy, seen what it contains, and ensured that there's no change, and sticking the neck out and saying there is no change. So the moment the module is built into the entire platform, that date gets auto-populated with the current revision date. So I know it's getting a bit granular, but that is what the regulator is expecting. The expectations have gone up multifold. So not just a bottom-up approach, but even in terms of integration with the other modules. Having said that, they do realize banks are in a state of they are on this journey. As long as they say intent, as long as they see intent, they're not being particularly strict about it. As long as you demonstrate that there are milestones, we are progressing, and they see demonstrable progress. So, from a purely speaking, from a banking perspective, this is what we've observed. This is what supervisors also are telling us. And after all, it'll go to help in terms of managing the overall compliance risk plus the risk in terms of the other various moving parts of the framework. Sorry, I took up too much time, but I just thought this is an important point to make.
Indeed, it was a
No,
very
it is very
interesting
helpful,
point
sir.
actually.
It is very important.
So few of our clients get that notification also from the RBI stating that your policies are not updated. So yes, they are keeping a watch on it. Yes, indeed, it was very interesting. We have received one more interesting question. Does one look at the usage of AI tools as a risk? What safeguards should be built around it? So AI, everyone is, now talking
Would
about
anyone
AI
like
and
to
using it
volunteer?
very.
Or should I put in my two
Maybe
bits
it's the
first?
last question
No,
and
sir,
then
I think
we will
we'd like to
conclude.
hear you, sir. Nikhil, sir, we'd like to hear you, sir, on this.
Yeah, thanks, Gaurav.
Absolutely.
So basically, I think AI is something which is definitely on the increase, and it is something which you have to live with, whether you like it or not. And I think what is important is that there should be an awareness, and B, there should be cognizance of the fact that AI is all around us. So, do we create a kind of a governance framework around AI? I think that is perhaps the best way to look at de-risking. That how can we be aware of AI? Do we know, for example, in our organization, how many people are using AI tools? I'm sure 90% plus of the organizations will say we don't know. And I think that is where the risk lies. Are they aware of the pros and cons of using AI? When they use AI, are they actually confirming the fact that they use AI? I'll give a totally tangential example. 2 years back, we spoke to the dean of studies in one of the most reputed schools, residential schools in the country. And we asked them that, look, what do you think about AI? And she said, well, Mr. Kochar, we've looked at AI and I don't think it's something that really applies to us. It's not something which is very useful. We are not using it. The students are not using it. And I personally found and felt that it was a kind of an ostrich approach because 1 week earlier, I had spoken to a 12-year-old girl who I met at a Diwali Mela in October. And I said, well, Myra, tell me how many students in your class use AI? And she said, Uncle, everyone. So, there was a sea change between the perception of the students and the perception of the teachers. I think if we look at ourselves as teachers, we really have to open our minds a little bit. It's the youngsters who are using it. There are a lot of risks as far as AI is concerned, but at the same time, there are a huge amount of benefits. I think what we really need to do is make ourselves aware, be totally cognizant, try to build up on the risk registers we build around AI, see that we are safeguarded against those risks, and then try to, implement a policy where whatever happens in an atmosphere of transparency, rather than finding out the hard way that AI has been used. Unfortunately, I think one of the large firms in Australia
Yeah.
had to suffer a fairly huge fine because maybe there were some various instances in a report for which a large amount of money was paid, and a lot of AI was used in that report, and it was detected. So you also have software which allows you to detect the
Yes.
use of AI today. So I think the more we are aware of these things, the more likely we are to be able to handle them effectively. Thank you. You're on mute, Deepika.
Hello, am I audible?
Yes, you are now.
So thank you, Nikhil sir. Very well put. And as we conclude the 30th episode of Excellencia series, I would like to extend my sincere thanks to our speakers, Mr. Nikhil Kocher, Mr. Jatin Thakkar, and Mr. Gaurav Jain for sharing their knowledge and valuable perspective that the compliance is a continuous strategic process, not just a tick in the box activity. Integrating risk management into your systems and strategy making business strategy supported by ongoing monitoring and structured risk assessment helps organization identify and mitigate the risk effectively. The discussion also reinforced that the importance of building a strong culture of compliance backed by training and alignment with the both Indian and international regulations. On that note, sincere word of thanks to everyone and to the JHS team for organizing the session and to Board Stewardship, our engagement partner, for their support. Thank you to all the participants for joining us today. Have a great day ahead. Thank you. Thank you so much.
Thank you so
Thank
much.
you for having us.
Thank you,
Thank you.
Jatin. Thank you,
Thank you so
Gaurav.
much.
Thank you, Deepika.
Thank you,
Thank
sir.
you, everyone.
Bye-bye.
Goodbye.
Have a great day.
Thank you.